Hello viewers, welcome to the channel. As we are approaching the tax season, we would like to give you some tips and do's and don'ts while filing your taxes and how to get the maximum refund for your tax returns. Today we are going to meet Sagar, who is very prominent CPA in Nashville area. He is very experienced in filing the personal taxes and also financial planning along with the business taxes. So we'll talk to him today and get his insights on how to file taxes for the better return and what are the do's and don'ts while filing the tax return. Let's meet him. Sagar, welcome to our channel and thanks for your time. Guys, this is Sagar, the CPA.
Before we start the interview, I just want to give a disclaimer that any insights or tips which we give in this interview are just for educational purposes. And if you have any specific personal situation, you would please contact your tax professional or financial advisor.
Thank you, Sagar, once again. And we would like to know more about you and what services you provide. If you can give some insights to our viewers, that will be helpful.
Sure.
Yeah.
Yeah, I'm Sagar. I'm a CPA in USA, and I'm also a chartered accountant and a cost accountant in India. We are well versed with financial and tax planning for individuals and businesses as well. So in Nashville area and especially for Tennessee, we support a lot of individuals, families, and businesses in their taxes and financial planning. So if you think anything about taxes or finances, we provide end-to-end services in Nashville, and we serve across the United States, all 50 states.
So to start with, Sagar, we want to understand what are the general do's and don'ts while filing the taxes. If you can give some insights, that will be helpful.
Yeah. So the general rule is whatever you're filing should match with whatever IRS has. So now the systems have been so integrated where your employers or where you work for, they all report whatever they're paying you to the IRS. So IRS already has a lot of information, whether it's your salary income or the interest you receive or the dividends you get. So what happens is IRS has a set of data already about you. When you file your tax return, it gets matched. The system automatically matches. So off late, what we've been seeing is a lot of people, they're getting notices because they don't report everything what IRS knows. You just pull up a few documents and file it, and IRS has some more documents left about you. So it's always good to first log into your IRS account and then pull whatever information IRS knows about you and make sure you include everything in your tax return so that everything matches and you don't get surprise notices.
Okay, that's great insight actually. But some people pay the taxes on their own.
Yes.
So do you give any tips to them? Because many don't go to a CPA, right?
Right.
So what do you suggest for the people who file on their own?
Sure. Yeah. So when you want to file by your own, as I said again, make sure you're putting every document in it and try to compare your previous year's tax return with this year's tax return. In that way, you know if there's any variations or you did any mistake. That's how IRS also does a comparison. They see the consistency in the reporting of your incomes and expenses. So as long as it's in line with your previous years and consistent, then it's one way, it's an indication to you that you're doing a right thing. But if there's something, if things didn't change much for you in this year, but your return looks different compared to your last year, then that's kind of a red light for you or an orange light for you to go back and review when you're filing.
Okay.
So something we changed recently is a lot of people, they do side gigs apart from their job, like photography or baking business. So these are all different side gigs. People have some little earned income. So what happens when people try to take money out of Venmo or Zelle or something like payment aggregators like this? So IRS brought in a new rule where if you're receiving more than $20,000 or 200 transactions, it gets reported to IRS automatically. The payment aggregators are reporting. So if you don't show that income in your tax returns, that's a big flag. So it's reported in a form called 1099K. It started last year. So IRS also knows what you're earning on your side. So better be careful to report your side incomes also in your tax returns.
So is this including all, for example, cash, Venmo, there are different apps, right?
Yes.
Is it including everything that limit, or is it for example, Venmo is this much or cash this much like that?
No, so the limit is common for everyone.
Okay.
So, but the other aggregator does not know what the, so for example, Venmo doesn't know what the Cash App does.
Okay.
So each one takes the 20,000 as a limit separately, but IRS actually counts the 20,000 limit as an aggregate.
Okay.
Yeah. So if you're using one payment aggregator and it's crossing 20,000, it's definitely get reported.
Okay.
So the other tip is try to file your taxes early, because filing it, e-filing and the direct deposits are working better now. So you get your getting refunds in like as quick as 3 days.
Oh, that's
So it's always better to e-file it and put a direct deposit checkbox.
Now you see in the recent days we see a lot of data theft and identity protection issues.
Yeah.
So can you give some insights on how to take care of that part? Yeah.
Sure. Yeah, I think as you rightly mentioned, off late we've seen a lot of data compromises, and people's socials are getting compromised, and there have been a lot of fraudulent returns being filed. So IRS brought in a good measure to plug this gap. So what they brought in is called Identity Protection PIN, IP PIN, where everybody can create a free IRS account in the IRS portal, irs.gov,
Okay.
and then they have an option to opt in for the IP PIN. So once you opt in for IP PIN, there is a unique PIN which generates every year, which someone needs to enter that PIN to file the tax return with IRS. So with this, there's a lot of fraud which you can avoid. So nobody can file a tax return with just your social or date of birth.
So whenever anybody tries, you need to give the PIN, right?
Yes.
So
it's a unique PIN generated every year, and it's in your account.
Okay.
And what we are seeing recently is there's a lot of people who are using outside services which are outside US, where what happens is all the security and control measures, what is required, they're not subject to or bound to follow those. But if there's someone who's doing it within US, you're subject to all those regulations. So you have to be careful if you are trying to file your tax return outside US, because that's where there are high chances for your data to be compromised.
Okay. Sometimes, Sagar, we keep hearing from people that they get a flag from IRS, they get audit request from IRS, or some people will get some additional questions from IRS.
Yes.
So can you give some insight on when these cases will happen?
Sure. So there are different type of notices or audits. So not everything is treated as an audit. There are a few notices, they're just like inquiries, they're just questions. So first of all, don't panic when you get something. So first try to read some maybe easy question and answer replies. So most of the times what happens is, as I said, if your return is not inconsistent with what IRS has, they'll send you an inquiry saying, hey, we've had some extra information about you, but you didn't report in your tax return. So in those cases, it's very simple. Just go and accept what IRS says and go and pay that extra tax or whatever it is. So that's one. But most other cases where you see the audit is because of different reasons. The main big reason is inconsistency and having higher variance compared to your previous year's tax returns when your activity or things have never changed. And then including fictitious or fraudulent expenses. I think of late, a lot of people are putting a lot of crypto losses, even though they don't have them. But when you do those, now it's a hot topic. Crypto is a hot topic, and there's some people put a lot of rental property losses, which really they don't have so much of loss. So these are very high areas where IRS scrutinies well, and the technology has grown so well that the system itself is generating flags and sending audit notices. There's no human looking at your return. With AI and the technology, the pattern is being observed and the notices are coming automatically.
Sagar, we keep hearing the very big buzzword in these days, one big beautiful bill. So what is that? Will that really impact our tax filing this year, or will there be any change in the way we are filing? I think many of the audience want to really know about this.
Sure. Yeah. So when the new administration came, they brought in this one big beautiful bill, and that was passed in July 2025.
Okay.
So it very well applies to this tax season when you're filing taxes. So some notable changes, though we can't cover everything in detail.
Yes,
some notable changes are for low or medium income workers. Earlier, taxes and tips and overtime used to be taxed. So now what they brought in is tips to the extent of $25,000 and overtime to the extent of $12,500 are exempt from tax. So all those people who are working in restaurants or hourly workers, they get some kind of a relief.
Okay.
And then for families, what they did is they've increased the child tax credit from $2,000 to $2,200. That's a little bit of benefit. And then they brought in some benefit for seniors, which is 65 plus, and they get extra $6,000 deduction in their taxes this year. And apart from that, some other notable changes which everybody can make use of is it's called SALT deduction, which is state and local taxes. In Tennessee, when we talk, we don't have state income tax, so it may not benefit to large extent for Tennessee homeowners or residents, but for if you're living in other state or having income in other states, like you have rental properties or so if you're paying any property taxes or income tax in other states. Earlier, it used to be only $10,000. Now you can deduct up to $40,000. It's like 4x in state tax deductions. And then the other important one is on your vehicles. So when people buy vehicles, what happens is you never used to make any deductions for interest you pay out of your vehicle loans. But now if it's a US manufactured car or a vehicle, you can claim up to $15,000 of interest
That is
deduction.
only for the US manufactured cars.
So the final assembly should have happened in the US.
Okay.
So for those cars and which are bought after Jan 2025, then you can claim deduction for the interest on those vehicles. So the other attractive one, what they brought in is Trump accounts for kids who are born from 2025 to 2028. So you can start kind of, it's not a retirement account because it's for the kids, but it's kind of a retirement account. All the rules which apply for your retirement account also applies to this account. You can't withdraw it early, you have penalties and all. But the attractive part is the government puts in $1,000 at the beginning into your account, and the parents can contribute $5,000 every year, which can be used either for the kids' education or for their marriage or for their business startups, so any other purposes when they grew up. So it eventually converts into their kind of a IRA or retirement account. But the good part is you get $1,000 to start that account. So it's always good. Take the $1,000 free money, don't leave it on the table, and it's left up to you how much you want to put it into that account.
So Sagar, next question is, I do get some questions from my friends because, for example, 2025 is already over. Still, is there any chance that we can still show some tax savings in the previous year?
Yeah, sure, definitely. Yeah, so though 2025 is completed, what one can do is there are different ways you can go and contribute back to your IRA account. If you have an IRA account, you can still contribute for the previous year, and that we can still get affected into the tax filing. Same way, if you have an HSA account, you can go and fund your HSA account still for the 2025 year. So these are any retirement accounts, IRAs, HSAs, you can still go fund, and that will still affect your 2025 tax return.
Sagar, along with the personal tax filing, you take care of business tax filing also, right? So
Yes.
can you give us any insights or suggestions for the business and also real estate users?
Sure, definitely. So for all small and medium business owners, there's something called qualified business deduction, QBI deduction, which is like 20% of their income is can be claimed as deduction.
Okay.
So that's one important thing, Section 199A QBI deduction, which one can claim. And apart from that, there is an important, very well used deduction is Section 179 deduction, where up to $2.5 million, if somebody is putting an investment into their business in the form of an equipment or any assets in the business, they can take a first year write-off.
Okay.
Instead of depreciating over 5 years or 10 years, up to $2.5 million, they can depreciate over entirely in the first year. So that's a very cool feature.
Okay.
And then what Big Beautiful Bill also brought in for business owners is 100% write-off for R&D expenses. So if there's a startup or any entity who's putting significant money in research and development, what government supports them is you can write off up to $100,000 in year one. So instead of earlier the rule used to be you have to amortize over 5 years, but now you can just deduct everything in year one. So that's another important feature to promote startups and R&D work the government has brought in. So that's some important tax benefits we can use for business owners. When it comes to real estate, again, there's plenty of things which we can do. The most common and or popular one is called cost segregation study. So what cost segregation study means is typically when you purchase a rental property, you depreciate that property value for if it's a residential over 27.5 years. So every year there's only a small portion of the building value which goes into your deductions. But when you do cost segregation study, what happens is the home value is actually split into different assets. Like the structure goes as a separate asset, your carpet goes as a separate asset, your roof goes as a separate asset, your appliances go and be treated as separate assets, and each asset has a different useful life. So the appliances, say it's only 5 years, the structure will be having a life of 25, 50 years. So in that way, what happens is you can accelerate depreciation on a wide variety of assets when you split it. So there's an engineering cost segregation study you do and split the value of your home into different assets. And on most assets are categorized instead of 27 and a half years as 5-year or 15 years. So you can accelerate depreciation and claim more in your tax returns. That gives you more deductions and better refunds. And then another way which a lot of real estate users do is short-term renting. So if you're these Airbnbs and also if you own those kind of properties, technically they're not treated as passive rental incomes, but they're treated as businesses. So the moment it is treated as business, you can depreciate it ahead or accelerate the depreciation. You can do the same things. So unlike a regular property. So that's one thing which real estate users can do. And then what other thing which the Big Beautiful Bill brought in is it's called QPP, Qualified Production Plans. So if there is any construction which someone started doing 2025 or later, which is non-residential, which is commercial basically, but used for manufacturing, you can write off the whole construction value in year one. So if you're putting $1 million into a construction, commercial, non-residential construction, you can write off everything in year one. So that's it's to boost the manufacturing in the states.
Yeah, definitely. That looks very actually attractive.
So now there's been a lot of crowdfunding which is happening for these kind of projects. So if you go and invest in those kind of projects, and you get your share of deductions in year one.
Sagar, next question is many parents, they save for their kids for college and they start paying into some plans. So will there be any tax savings for such kind of plans?
Yes, there are different ways people try to invest for their kids' future and try to save taxes, but it depends on which state you're living. So the most popular one is the 529 plans. They are the state-sponsored plans for kids' college savings, and where they're restricted kind of accounts. Like if you save something in it, you have to only use for education purposes. So if you withdraw it, you have to, you're subject to penalties, and the returns are limited. And especially for Tennessee residents, we don't have individual income tax, so you literally can't get any benefit out of tax savings if you put into a 529 plan. So there are like a lot of ways around where we can do it more advantageously, tax saving strategies for kids' college savings. And another important factor is what people miss when doing their 529 plan savings is those are reported in your FAFSA forms in your college. So there are high chances that kids get they're restricted in their scholarships, and so that's a big hit. So in spite of, it's like penalizing you for saving money for your kids. So rather than that, you have to try to save in a different means where you still save for your kids, but you get away with the FAFSA reporting, and your kids still get high scholarships. So we work with different families and get these tax advantage products other than the 529. So we specialize in that.
So on the last point, when you say other than 529, where can we invest for such kind of things, like for the kids' education primarily?
Yeah, so there are common tax saving products or platforms where it's not just restricted for kids' college saving. It's like a multi-purpose saving strategies where you can use it flexibly either for college education, or if they don't need, they get good scholarships. You don't really need a 529. But you never know when your kid is in a high school or a middle school whether they will get scholarship or not. You start saving in 529. End of the day, if they are performers and they get scholarships, you have to pay penalty and withdraw that. But instead, the other products where you can use it for multi-purposes, and you also don't need to pay taxes, you can get avoidance from FAFSA reporting.
Yeah, Sagar, my next question is, many people wonder, especially in US, how to protect your assets and plan for a protection plan. So can you give me some insights on that?
Yeah. I think everyone here, especially the immigrants, everyone tries to own a home, or eventually they'll buy a rental property and then add their rental property. So a good amount of real estate is built up in everybody's investment portfolio. So then how do you protect these assets from lawsuits or things? So people try to create LLCs and put their real estate properties in each LLCs. In that way, what you can do is you can protect your LLC with your rental property with the LLC, so that if there's any lawsuit or any claim, it doesn't affect your personal assets. So you're just creating a circle and putting your property in that circle. So it's the maximum loss you will have is just the value of the property. or any assets in that LLC, which is like particularly a bank account balance in that LLC.
Okay.
But you're safeguarding your personal assets like your 401k money or your bank balance or your personal residence, your car, all your personal assets. So that's a good strategy, and we help a lot of people in doing this protection, asset protection. And apart from that, everybody needs will and trust. It's called estate planning. In the US, there is something called probate, where your assets doesn't automatically transfer to your next generation by default. But there's something you need to prove, the next generation should need to prove in your absence that they have a will or a trust. So that's very important. And we also integrate this asset protection we talked about with this. So you put your LLC into your estate plan, which is into your trust and will, so that it becomes holistic. It's not just your LLC for the assets. You also combine it with the estate plan. Then you'll have your holistic asset protection plan. And we also, when doing this, we also do for family protection, like how do you protect your family, take your term insurance or any other kind of security measures for your family. So we work as part of their individual family or financial planning, do all these asset protection and family protection plans.
Okay. Viewers, hope this information helpful for you. So if you want any help with your tax filings or financial services, please reach out to Sagar. Their firm name is Kota Financial Services. I'll provide their contact details in the description. So please reach out to them. And Sagar, thank you so much for your time, and you provided us a lot of helpful and insightful information. Thank you so much.
Thank you. It's nice meeting you and talking to the viewers and giving insights to them. Everyone, please subscribe to Tennessee Indian, our local channel. Please support the channel.